Hi, I'm Tekoa De Silva with Sprott Global Resource Investments, and I'm sitting down here today in the office of Rick Rule, Chairman of Sprott U.S. Holdings. Rick, good to see you.
Tekoa, thank you for having me on, and congratulations on your decision to join Sprott. I'm delighted that you're interviewing us as part of the team rather than in your former independent role. Thanks for coming to join with us.
Thank you. It's a pleasure to be here. So now, Rick, you've spoken for about a year now about an impending bear market bottom in precious metals and natural resources. Are we there yet now, and why?
I suspect we are. I don't know for sure. And if we are, your listeners, or now our listeners, need to understand that it will still be volatile. If we've reached the bottom, which I believe we have, we'll see a rising channel with higher highs and higher lows, but we'll still see volatility, which one day will elate you and another day will terrify you. People need to understand that. That's the way this thing works. As to the rest of your question, that is the reasons why I might believe that we've put in a bottom. I think there are three reasons. One, as we've discussed before, bear markets are the authors of bull markets, and this one will end. If it's ended, I'm not sure. But certainly we've seen extremes in terms of bear market pricings with regards particularly to resource equities. And valuations in and of themselves are often the authors of the end of a bear market. Another thing has to do with the price action that we're beginning to see in both commodities and equities. If we observe the year 2003, the first third of the year was truly terrifying. We had buyer exhaustion, we had forced sellers. And so the stock charts the price charts of both commodities and equities resembled the topographic maps of ski hills, falling rapidly from the upper left of the page to the lower right of the page. The middle part of the year, we had a flatlining experience on very low volume, where sellers were exhausted, but buyers were exhausted too. And so the stock charts were horizontal. At the end of the year, we began to see bifurcation. Bifurcation occurs when the best of the issuers and the best of the commodities catch bids, small bids, but in the absence of sellers, you have some pretty dramatic price moves relative to the size of the bids. So you saw some of the better juniors, the Eurasians, the Almadens, the B2s of the world, up 40% on fairly low volumes. This has to do with the fact that value shoppers come into the market and they buy small amounts of stock in the absence of sellers. And that's a classic sign of a bear market bottom. What you need to confirm a bull market now will be rising volumes, rising price on rising volumes. The prelude to that in the equities markets, Tekoa, has always in the past been issuer capitulation. Issuer capitulation happens in the juniors, where the better players among the juniors, the top 20% of the issuers, understand that you can't finance just to survive. You have to raise enough money to advance your assets to grow, to answer unanswered questions. That happened before in my life, certainly in July of 2000, where the very best of the junior issuers, the Ross Beatties of the world, the Bob Quartermains of the world, the Lucas Lundins of the world said, we need to raise money, we need to price the equities in a way that will clear the market, we need to beneficiate our projects. Yes, our share prices are down substantially over 3 years, but that doesn't matter. We grow or die. And when that decision was made in 2000, in July of 2000, it kicked off a spectacular rally in the best juniors. The worst of the juniors continued in a downward trend, 2000, 2001, 2002. But the best of the juniors returned 100% compound internal rates of return at the bottom of a bear market. And that's ultimately itself, that performance, what kicked off the bull market. It's important to know that.
Rick, I had the chance to interview you back in October, and you mentioned to me at that time that it's the duty of honest investors to reorganize their portfolios at the bottom. And I'm wondering if you can speak to that concept.
Yes, and that's a very important point, Tekoa. People understandably don't want to admit defeat to themselves. So somebody will have bought a stock at $4 and the stock is selling at 40 cents. And they say, I can't sell this stock at $4. If I do, I'll lose $3.60. And while that point of view is understandable, it's wrong. You've already lost the $4.60. The question is simply, what are you going to do with the last 40 cents? If you re-examine your premise and you say, it doesn't matter that I paid $4 for the stock, it's selling for 40 cents and it's worth 90 cents, that's okay. That's okay. Because what you've done is you've made a decision with the 40 cents you have left in the stock. But if your only decision is, I can't bear this, you're abdicating responsibility for your future. What's important is not that you paid $4 for this stock. What's important is what's the highest and best use of the 40 cents that's remaining. It's a difficult thing to do. It's absolutely critical. And simply doing that one thing, being honest with yourself, will allow you to outperform 80 or 90% of your competitors who think that the price they paid for a stock is somehow relevant.
Looking at this recovery that we're going to be going into, what asset classes, Rick, generally will lead a natural resource recovery?
Well, I'm embarrassed to say, and I hate giving people license like this. In truth, a rising boat will float, or rising tide will float all boats. But I think you owe it to yourself to be discriminating. Certainly, the most certain way to play a resource recovery is to find markets where the selling price of the commodity is below the average cost to produce them. Markets where the commodity price must go up in order for there to be supplies to sustain mankind. So examples of commodities like that are platinum and palladium, where the industry is priced below production cost and where the utility users, in terms of the air quality that you can see behind me, is a function of the utilization of platinum and palladium. Uranium would be another example. It costs us $70 a pound to make the stuff. We sell it for $35 a pound. Either the price goes up or the lights go off. It's just as simple as that. Zinc is priced below the cost of production. So the safest way to play the game is to ask yourself investment questions where the answer begins with when. Because these prices have to go up. If they don't go up, we don't have any more of this stuff. I remember answering the same type of question 15 years ago. And it was very clear to me then, when it cost the industry $1.25 to make a pound of copper, and copper was selling for 80 cents a pound. Listen, two things have to happen here. Either the price of copper has to go up, or there won't be any electricity, because that's how we get electricity. Sure enough, the price of the commodity went up. In terms of maximizing one's own utility in a bear market, one needs to decide how much risk wants to assume in one's portfolio. Because at the other end of the spectrum, away from things that have to happen, but where the price rises or 50% rises or 60% rises, on the ragged edge of speculation, the silly edge of speculation, in the exploration stocks, what you do there is you take substantially more risk, because you're not asking yourself a when question, you're asking yourself an if question. But the value of a yes answer is so much greater. And in truth, I think that in the junior sector, for investors who take the time to identify those 20% of juniors that have competent management teams that earn respect in the market, in the mining community market, have reasonable assets, reasonable properties, and have the ability to simply stay alive for 2 or 3 years, the worst of the best companies, if you will probably triple over 3 or 4 years. The best of the best companies will generate 10-fold or 15-fold responses. But in order to get this 10 or 15-fold responses, you're going to have to accept several losses, individual losses in your portfolio. You're going to have to take a lot of risk to get those big wins. So the truth is that a rising tide will float all boats. How one plays this rising tide will have very much to do with an investor's appetite for work, with how much reward they want to get, which is a function of how much risk they're willing to take, and whether or not the investor can absorb the volatility that they will experience in the recovery. I would suggest to you as an example, Tekoa, that the decline that we've seen in the gold price from $1,900 to $1,200 was not the end of a cyclical bull market. I think it was a secular decline in a secular bull market. And that will tell you something about the nature of the volatility that we have to experience going forward. In the great bull market of my youth, when I was going through the same learning period that you're going through today, that was in the 1970s, it was truly an epic bull market. The gold price, as an example, rose from $35 an ounce to $850 an ounce. Natural gas prices rose from 25 cents a thousand to as much as $13 a thousand. Truly an epic bull market. What many students of history don't recognize is that in that 10 or 12 year bull market, there were probably 10 or 12 price declines in gold of 20% or more. You had cyclical declines in a secular bull market that, if you weren't prepared for them, if you didn't have the cash or the courage to stay the trade, shook you out of what was truly an epic bull market. And in the middle of that bull market, in the end of 1975, 1976, the gold price, having run from $35 an ounce to $200 an ounce, fell by fully 50%, from $200 an ounce to $100 an ounce. Many, many, many people who had been right about gold lost their courage or lost their conviction and got shaken out of the gold trade in time to miss a move in gold from $100 an ounce to $850 an ounce over 5.5 years. And the lesson in this bull market recovery is that we will see higher highs and we will see higher lows. But we will see 20% perturbations in price that will either elate or terrify people, depending on the direction of their bet and the direction of the market.
So Rick, on that subject there of gold, the next chapter is volatility from here on out?
Certainly. I am surprised by the lack of volatility that all markets have exhibited since those interesting events of 2008. I would have expected the market to experience much, much, much more volatility than it has. I suspect that what happened is that we had a soporific in the market, a sedative, if you will, heroin in the form of quantitative easing and short-term credits. But one would suspect that as the artificial benefit of short-term credit begins to be less and less felt in the market, just as increasing doses of heroin are less and less felt by the addict, that one of the symptoms of withdrawal is going to be volatility. And a speculator should learn to welcome volatility. If you understand the nature of the move that's coming in resources, what a 20% decline in the market is a 20% off sale. And what shopper, shopping for a good, be it a physical good or a financial good, wouldn't welcome periodic 20% off sales?
You know, Rick, you produced a document a number of years back called 9 Nosy Questions to ask the management of a company. But if I can ask you, are there a couple questions, Rick, that you would advise someone to ask their financial advisor? Because you said a moment ago, someone who has the willingness to do the work. If they're entrusting someone else, what questions might you suggest that they ask that person?
That's a great set of questions, Tekoa. And I would ask an investor to ask his advisor, first of all, why you? There's hundreds of thousands of people who are willing to take a commission in order to tell me what I do with my money. And the answer better include a specific focus on whatever the investor is interested in. If the investor is interested in financial services stocks, then that investor's advisor better know something about financial services stocks. And the institution that he or she works for had better know something about financial services stocks. The idea that in an investment climate that is as diffuse as it is today, with 70,000 publicly traded instruments worldwide, that any institution, let alone any individual, has expertise across the length and breadth of the market is fiction. If your advisor doesn't have specific expertise with regards to the topic that you are asking him or her to address, fire him or her. The second thing is that you need to ask your advisor to describe in specific terms the market conditions that he or she inhabit, what circumstances they believe drive the market, and what the correct strategic responses for an investor are in the context of the specific market that the advisor is advising on. If the advisor can't give a good response to that, fire the advisor. The third thing is you need to ask the advisor, what specific support do you get from your institution that makes you competitive in my market? If you look at Sprott as an example, this is a commercial, thank you for the opportunity. We are probably the world's largest investor in microcap natural resource equities. We have the ability to address these issuers as equity investors, as debt investors, but our size and scale means that we carry on more conversations than any of our competitors, and we are able to focus more evaluative resources, that is, geologists, geophysicists, and engineers, than any of our competitors. Our strategic advantage is simply that we are a $10 billion institution in terms of assets under management and assets under administration that's solely focused on natural resources and almost solely focused on microcap natural resources. If somebody came to Sprott and asked us, should I buy 1,000 shares of GE, they shouldn't listen to our response because we have no time, experience, and attention in GE. But if somebody comes and asks us a question about small cap or micro cap oil and gas or mining shares, we are probably better prepared than any competitor in the world on a global basis to answer that question. And that's the nature of the discourse that needs to take place between a customer and an advisor, irrespective of the sector that the customer intends to invest or speculate in.
Just as a secondary question to that, I had the chance to speak with you a little bit earlier today, Rick, off camera, and you mentioned that in your earlier years of the firm, if the firm was making, let's say, for example, $1 million in 1 year, 20% of that might be spent on research and dealing with geologists and so forth. Could you talk to that?
Yeah, absolutely. People mistake the nature of almost every business. The junior resource business is an exploration business, which is to say it's not really an asset-intensive business. It's a research and development business. You make money in natural resources and exploration by answering a series of unanswered questions.